So let's talk to Eileen. Good morning.
Good morning, James.
Thank you very much for doing this. I know it's a bit like Stephanie last week. It's very early in the morning for you on the east coast of the US, but nevertheless, you've given up your time to talk to us, so we're very grateful.
No problem. I'm still on London time, so.
Okay, fair enough.
It feels good.
So I think, as usual, if you just start off by giving us a sort of bit of background onto the fund and what it's trying to achieve, please.
Yes, absolutely. So again, thank you for having me on. I appreciate the opportunity to speak with you and your audience about Ecofin and the Ecofin US Renewables Infrastructure Trust, which we refer to as Renew or RNEW, its ticker. So indeed, I'll walk us briefly through a few slides here about Ecofin first, and then more specifically about Renew. So Ecofin is a $2 billion, give or take, asset manager with a 30-year history of uniting ecology and finance, hence the name. Ecofin is part of Tortoise Ecofin, a leading energy-focused asset manager with approximately $9 billion, again, give or take, assets under management. Ecofin's mission is to generate strong risk-adjusted returns while optimizing our investors' impact on society. And optimizing their alignment with the UN Sustainable Development Goals, or SDGs, as you can see there. As a firm and as individuals, we're dedicated to climate action, to clean energy, to water, social impact, et cetera. And we do that through products that include public equities, private credit, and private equity. I think we can move to slide 2, if that's okay. I won't go into too much detail here, but I wanted to give a sense of our team and of the platform that supports Renew in particular. Several members of the team, myself included, and Ed Russell and Jason Benson, are focused exclusively on private sustainable infrastructure, including on Renew. And the asset management team of Nancy Johnson, David Govert, and Marnie Kenward are dedicated to managing the solar and wind assets in the Renew portfolio in particular. Many of the other faces on this page are either Ecofin London-based employees who support research and marketing, compliance, and other efforts, or are shared resources from Tortoise Ecofin's headquarters in Overland Park, Kansas, including and especially the financial operations team led by Brad Adams. So there are approximately 45 people total, we obviously didn't picture them all, dedicated to Ecofin, and 70 people in shared services at Tortoise Ecofin as a whole. Lastly, before we move on the bottom right of the page, you'll see the names and the brief bios of our wonderful Renew board of directors. So I think we can move to slide 3. So I'll now be speaking more specifically about Renew, or the Ecofin US Renewables Infrastructure Trust. So what is Renew? Well, Renew is a UK investment trust invested in a diversified portfolio of renewable assets in the United States. Renew has the option to invest in other OECD countries, but to date, we haven't done so, in part because of the massive opportunity in the US market, which we'll get back to later. Renew is primarily focused on solar, both ground mount solar and commercial and industrial rooftop solar, and focused on onshore wind generation assets. But other eligible sectors for the fund include battery storage, biomass, hydro, microgrids, et cetera. We have a 15% bucket for sort of ancillary technologies that, again, we haven't used yet and would need more money to do so. We have a middle market focus. We believe that the project sizes in the middle market lend themselves to bilateral negotiation, most importantly, and also are too small to be overbanked. We face less competition in the middle market, in part due to our own network of relationships that generate proprietary deal flow. Renew provides stable income from its portfolio with 100% contracted revenues. And the power purchase agreements, the PPAs that underlie those contracted revenues, have a remaining average life of about 15 years. The trust is currently fully invested in 65 high quality and geographically diverse, by which I mean spread over 8 states within the United States, solar and wind projects. Our off-takers who've contracted to buy the power under these long-term power purchase agreements are universally investment-grade entities. We invest in mainly operational projects, but also some projects that are in construction or are construction ready. Since its IPO in late 2020, Renew's assets have generated approximately 430 gigawatt hours of clean electricity. This would be equivalent to about 250,000 tons of CO2 emissions avoided and about 40,000 households supplied. Our aim is to provide Renew's investors with an attractive yield and the potential for modest capital appreciation over time. Renew has paid 7 quarterly dividends since IPO, totaling 7.4 cents per share, or a current annualized dividend yield of 6.5% based on our current trading prices. My team and I manage the projects actively, seeking efficiencies and way to reduce costs. Why don't we go to slide 4 if we could. So let's pivot a little now to the ongoing and rapidly growing market opportunity for Renew. And let me just highlight, I think, some of the drivers beyond that growth, which you can see projected here on the slide. We benefit from significant long-term structural tailwinds that are poised to sort of supercharge, I would say, the U.S. renewables market in the coming decade and beyond. So as you said earlier, our competition may be a little daft, your word, not mine, but I can't say I disagree. And that's about all I'll say about that. Let me enumerate some of the more significant drivers of this growth that we're so excited about. The first driver is really government legislation, and that includes tax incentives for renewable energy. And it also includes, most notably, I guess, the $370 billion Inflation Reduction Act passed in August 2022, which has understandably gotten really all of the attention. But government legislation that's providing these tailwinds also includes the Infrastructure Investment and Jobs Act, which was passed in November of 2021, which, among other things, provided about $65 billion of funding for the clean energy transmission and power infrastructure upgrades that are needed to support the growth of renewables. And it also includes the CHIPS and Science Act, which no one pays any attention to, which was overshadowed, I think, because it was passed around the same time as the Inflation Reduction Act. And the CHIPS and Science Act, which on the face of it was geared towards supporting the semiconductor industry in the US, itself committed $67 billion of its total funding towards accelerating the growth of zero carbon industries and climate relevant research. So together, these three legislations alone represent over $500 billion of federal government incentives supporting investment in renewable energy. I haven't even included all of the state, municipal, and local incentives of a similar nature, and of course, all of the corporate and industrial climate pledges and commitments that have occurred in recent years. That includes, by the way, 22 states and the District of Columbia that are targeting 100% renewable energy or carbon-free electricity by varying targets, 2040, 2045, 2050 at the latest. So the second driver of growth is the desire for greater energy security and energy independence in the United States. This involves both national security concerns and also economic motivations, like reducing volatility from exposure to energy price fluctuations. And by the way, hence the name of the Inflation Reduction Act. It also reflects the desire to re-domesticate the production of important energy equipment and to reduce our dual vulnerabilities, first to Russian and Middle Eastern gas and oil, and then, of course, now to Chinese production of most of the world's polysilicon and PV solar panels. So we've basically gone from one vulnerability to another, and it would be good to get rid of those vulnerabilities. So the third driver, I would say, is increasing demand for energy overall, especially as we seek to decarbonize industry and as we seek to electrify transportation and other sectors of our economy. Fourth driver, I would say societal concerns about climate change, increasing concerns about more frequent and increasingly severe natural disasters, and just a general desire to save the planet for future generations my kids and your audiences included. The fifth driver, declining costs. Overall, despite sort of recent setbacks in some cases and supply chain logistical issues that we faced last year, overall, the costs of installing solar and onshore wind generation on a combined basis have declined by about 70% over the last decade, as we all know. And this is another driver that's worth mentioning. Sixth driver, and last but not least, I would say, the massive size and relative underpenetration of the US renewables market versus its peers in the UK and Europe has to be acknowledged. To give some perspective, the US power market is about 12 times the size of the UK power market and about 1.3 times the size of the European power market, according to Bloomberg NEF. So for the sake of time, I've ticked through a lot of those drivers rather quickly, but obviously happy to circle back to them at any point later. The point being that Renew's market opportunity and addressable pipeline is dozens of times bigger than the trust as it currently stands. And we have the industry relationships and the experience to identify and pursue the most attractive of these projects. I also want to point out that these structural drivers are not, and I think this is a common misperception, or at least should not be, political in nature, and they will continue regardless of political administration in the US. So why don't we move to slide 5, and I'll kind of run through slide 5 and 6 here. This just shows you a few facts about the makeup of the Renew portfolio currently, and hopefully maybe helps answer the question of why Renew. Currently, we have 65 assets, again, across 8 states, as I mentioned, and close to 180 megawatts of capacity, with long-term contracts with creditworthy, investment-grade counterparties. These are high-quality assets. They are operating and cash flowing as expected. Renew's UK trust structure gives investors, there in the UK, access to the huge US renewable sector, which is otherwise hard to find in the US market, as you mentioned, in the UK market, as you mentioned, and soon getting harder to find with our only pure play competitor inexplicably closing up shop. So Renew is differentiated by steady cash flows, by an attractive dividend yield, and by its SFDR Article 9 status. I should point out that this Article 9, sort of quote unquote, dark green status has proved difficult for other trusts to achieve or maintain, at least in the market. And according to Morningstar estimates that I recently read, less than 5% of all European fund assets can actually make this claim. So I want to point out the Article 9 status. I'll end there by saying that I hope you're as impressed with the Renew portfolio as I am, and are as excited about our prospects for growth as we at Ecofin are as well. I think we've gone through all the slides, although there may be 1 or 2 more, and we have some appendices that we can refer to as needed.